You know that universal feeling of relief when you finally cross something massive off your calendar? Think about it for a second. Maybe you just finished a, a huge presentation for work.
Right. Or a really stressful meeting.
Exactly. A high-stakes meeting you've just been dreading for weeks. You walk out of the room, you exhale, your shoulders drop, and you just feel, safe.
Oh, absolutely. I mean, it's a very natural psychological response.
Yeah.
The scheduled event is officially over, so our brains immediately tell us, well, the danger must be over too. We survived the calendar date.
We survived, the storm has passed. But what if walking out of that room didn't actually solve the underlying problem? Like, what if the calendar just flipped a page, but the structural damage, the real fundamental cracks in the foundation, was actually quietly getting worse while you were busy popping champagne?
Yeah, that is the ultimate illusion of safety. And looking at the data from the global economy right now, it's exactly what we're seeing play out on a massive scale.
Wow.
Yeah, the market absolutely loves a finished schedule, but it really hates doing the math on what comes next.
Well, welcome to the deep dive. Today, we're exploring a massive disconnect happening right under the surface of the global financial system. We have a single, incredibly dense, and frankly fascinating source strategy memo driving our conversation today.
What's a great piece?
It really is. It's dated exactly today, Wednesday, June 17th, 2026, and it's titled The Settlement Lag.
And, lag really is the perfect word to anchor this whole discussion. We're looking at this really dangerous gap between what the market feels has been settled and the actual mathematical bill that still has to be paid.
Right. And the mission for our deep dive today is to decode this exact disconnect for you. Because right now, the financial markets believe a series of recent events have basically solved global economic uncertainty. Everyone on Wall Street is cheering.
They really are.
But this memo argues that the market is celebrating a total mirage. They're just ignoring a ticking clock of structural debt. So, to help you connect the dots, we're going to break down this complex financial landscape piece by piece. Let's start with what the market thinks is happening before we tear it down and look at reality. There's this concept right now called the three-chair consensus.
Yeah, the three-chair consensus. If you look at the heavyweights on Wall Street this week, BlackRock, Merrill Lynch, JPMorgan, they're all essentially operating in the exact same narrative.
Which is what, exactly?
The consensus is that three major central bank decisions are finally behind us.
Yeah.
So you have the Bank of Japan, the U.S. Federal Reserve, and the Bank of England. They've all had their big, highly anticipated meetings.
So the suspense is gone.
Exactly. The calendar is clear.
And on top of that cleared calendar, there's this supposedly signed Iran oil deal that everyone assumes is going to bring back a massive risk-on environment, meaning investors feel totally comfortable taking big swings again.
Right? Risk-on restoration. Everything looks great on the surface. The S&P 500 is up. And there's a really specific metric we need to look at here, which is emerging market debt spreads. Specifically, the EMBI has compressed down to a very tight 231 basis points.
Okay, let's unpack this, because that metric is huge.
It is. Let's break down what that actually means, because it's a crucial measurement of fear, or in this case, the complete lack of it.
Right.
So the EMBI, or Emerging Markets Bond Index, tracks how much extra interest investors demand to hold debt from developing nations compared to, ultra-safe U.S. Treasuries.
Okay.
When that spread compresses or shrinks down to 231 basis points, which is just 2.31%, it means the market perceives virtually no risk.
Right. So if a U.S. Treasury is paying 4%, a developing nation is only paying around 6.3%. Investors are practically throwing money at emerging markets, assuming their economies are perfectly stable. But looking at the actual macroeconomic backdrop, it feels like the market just survived finals week, went out to a massive party to celebrate, and completely forgot they still have hundreds of thousands of dollars in student loans to actually pay off.
That's a perfect analogy.
Yeah.
And taking that student loan analogy a step further, they haven't even looked at the interest rate on those loans.
Oh, man.
Yeah, they finished the exams, they feel successful, but the structural reality of their financial situation hasn't changed at all. The memo's core thesis is that the market is entirely confusing the resolution of events on a calendar with the resolution of deep structural imbalances.
Which means we need to look at the actual bill coming due. Because the calendar might be clear, but the decisions made in those central bank meetings fundamentally altered borrowing costs globally, right?
Oh, absolutely. We're looking at the end of the free carry era.
The end of the free carry era. And it starts with the simultaneous shockwaves from two specific central banks.
Yeah, we really have to look at the Bank of Japan, the BOJ, and the U.S. Federal Reserve together to understand the trap that's been set here. So first, the Bank of Japan just printed a 1.0% interest rate.
Which is huge for them.
Massive. And Deputy Governor Uchida fronted the press conference to make it absolutely clear to the world that this is the new reality.
And meanwhile, in the U.S., the Federal Reserve, specifically noting Kevin Warsh here, held rates steady. But the vital detail is that they officially removed their easing bias.
Right. The easing bias is gone.
Let's clarify that for a second. An easing bias basically means the Fed's default posture was, hey, our next move is probably going to be a rate cut. By removing that bias, they are explicitly telling the market, actually, we might have to raise rates again.
And futures markets are taking that very seriously. They're now pricing in a full 25 basis point hike by year end.
Because of the PPI.
Exactly. Driven by the Producer Price Index. That PPI number is critical. It tracks what businesses pay for raw materials, and it's running incredibly hot right now at 6.5%.
Wow. 6.5?
Yeah, and since businesses eventually pass those higher costs onto everyday consumers, a hot PPI today means high consumer inflation tomorrow. So the Fed is trapped.
They really can't lower rates. But here's where it gets really interesting. If you're listening to this and trying to connect the dots between a Japanese interest rate, the U.S. Fed, and a developing nation like Ethiopia or Pakistan, wait, if I'm a developing nation, why does a Japanese interest rate hike suddenly blow up my national balance sheet?
It's a great question. It all comes down to the mechanics of the global carry trade.
Okay, break that down.
For years, interest rates in Japan were essentially zero or even negative. So if you're a major investor or a frontier sovereign nation, you could borrow massive amounts of money in Japanese yen for practically nothing. That cheap money is the free carry.
Ah, so you take that basically free Japanese money and you use it to refinance your own national debt, which carries a much higher interest rate.
Exactly. You're pocketing the difference to keep your country's finances afloat.
Mm.
It works beautifully as a financial lifeline, provided the Japanese interest rate stays at zero.
But it's not zero anymore.
No, the BOJ has raised it to 1.0%. The era of free money is instantly over. And simultaneously, the U.S. Fed is indicating rates will stay high. So the cost of borrowing everywhere is suddenly aggressively spiking.
Which is exactly what the IMF warned about, right?
Yes. The International Monetary Fund had explicitly warned the market about this exact scenario. They stated that the resilience of emerging markets relied entirely on contained, predictable volatility in developed market rates.
Meaning, as long as the U.S. and Japan keep their rates low and stable, developing nations can survive.
Exactly. But that stability is totally gone. The math has changed. And yet, if you look back at that EMBI spread we mentioned earlier, that super tight 231 basis points, the market isn't pricing in this new reality at all.
It's just wild. They're ignoring the danger for vulnerable countries like Pakistan and Egypt.
Totally. The market is pricing in the relief of the calendar event while ignoring the math of the carry trade unwinding.
Okay, so borrowing costs are structurally higher across the globe. That's one major pressure point. But if you talk to an optimistic trader right now, they'll pivot and say, well, sure, the cost of money is up, but look at the cost of energy. Oil prices are down to $85 a barrel. That has to provide some serious relief, right?
You'd really think so, but the memo totally dismantles this oil relief narrative.
Yeah.
Yes, the current price flashing on the screen is $85 a barrel. And that's largely because the market believes this major deal with Iran is finalized and about to restore a massive amount of supply.
Right. But first of all, that Iran deal is heavily contested. And just a quick note for you listening, we're completely neutral on the politics here. We're just reporting what the data reflects.
Right, exactly.
Former President Trump publicly calls the deal signed, while Iran publicly calls it misrepresented, so it's murky. But even if we put the geopolitical theater completely aside, the actual supply and demand math from JPMorgan is terrifying.
It really is. What's fascinating here is the sheer scale of the illusion. JPMorgan's analysis shows that there is currently a massive 20 million barrel per day disruption in the global oil market.
Yeah, wait, 20 million barrels?
Every single day.
So how is that massive gap being covered without the price of oil absolutely skyrocketing?
Well, JPMorgan tracks exactly how that gap is being patched together. Workaround supply, meaning shadow fleets and rerouted shipments, covers 30%. Demand destruction, which literally just means global consumers are too squeezed to buy as much fuel, covers 27%.
Okay.
And a temporary pause in Chinese stockpiling covers another 13%.
And here is the absolute kicker, the rest of it. 29% of that massive 20 million barrel daily gap is being covered by draining the United States Strategic Petroleum Reserve, the SPR.
Yeah.
The data shows the U.S. is draining the SPR at a staggering pace of 6.1 million barrels a day. Out of a total committed 172 million barrels, the U.S. has already released 66 million.
And we really have to remember what the SPR actually is. It's a finite emergency resource. It's not new oil production.
Right. It's a piggy bank meant for natural disasters or acts of war.
Exactly. And JPMorgan calculates that at this current draw rate, without a fully functioning Iran deal to restore actual production, the U.S. Strategic Petroleum Reserve will hit 1983 levels by mid-September.
1983. I mean, to put this in a context we can all relate to, think about your own household budget. This is exactly like paying your monthly mortgage by quietly draining your emergency savings account.
Yep.
As long as you keep making the transfer, it works perfectly. To the outside world, your checking account looks totally normal, bills are paid, right up until the day your savings account hits zero.
And then you're in immediate default. The current $85 price of oil is artificially subsidized by an emergency drawdown that has a hard expiration date. By mid-September, that savings account runs dry.
And the danger this poses for oil-producing nations like Nigeria, Angola, and Ghana is extreme.
Oh, it's catastrophic. Their entire national budgets, their revenue projections, they are all tied to this fragile $85 illusion holding up.
Because when the SPR drain inevitably stops, the true supply shortage will instantly reflect in the price.
Right, creating incredibly violent volatility that those countries are just not prepared to handle.
Okay, so let's step back and look at the board. We have global borrowing costs silently exploding because of the BOJ and the Fed. And we have energy prices artificially suppressed by an emergency reserve that's draining fast. If we follow the chain of macroeconomic dominoes, who is absorbing all of these shocks globally right now?
It leads us straight to China.
China.
Yeah, China is the world's factory floor, and the data coming out of their manufacturing sector right now is staggering. We're seeing a massive divergence between two key metrics.
Which ones?
So China's factory gate prices the Producer Price Index, or PPI, which tracks what it costs manufacturers to make goods, rose 3.9% year over year.
Wow.
But consumer prices, the CPI, what people actually pay at the register, only rose 1.2%.
Wow. That is the biggest gap between the cost to make a product and the cost to sell a product in nearly 4 years.
It is.
Let's break down exactly how that mechanism works in the real world. Energy costs are rising, making it much more expensive to run the massive factories in China. So production costs go up nearly 4%. But domestic demand inside China is incredibly weak right now. Consumers aren't spending.
Right.
So manufacturers literally cannot pass those extra costs onto the consumer without killing sales completely.
They are completely trapped. The manufacturers are just forced to eat the losses. Their profit margins are getting squeezed into oblivion. Even though Chinese exports are up 19.4% and imports are up 27.5%.
Which is a $1.2 trillion trade surplus, right?
Exactly, which creates this massive headline number. But under the hood, the manufacturers themselves are actually bleeding cash on the factory floor because of the margin squeeze.
And this is exactly how a margin squeeze in China becomes a crisis for the developing world. Because Chinese factories are watching their profit margins evaporate, they immediately look to cut costs.
They have to.
Right, so they demand fewer raw materials, fewer commodities from their emerging market suppliers. They buy less copper, less coal, less iron ore.
And if we connect this to the bigger picture, you have developing nations supplying these materials who are suddenly getting hit from both sides simultaneously.
Double whammy.
Yeah. Their biggest customer, China, is drastically cutting back orders because of the margin squeeze. And at the exact same time, as we discussed with the Bank of Japan, the cost to service their own national debt is skyrocketing.
Which brings us to the ultimate warning signal in the data today. The canary in the coal mine, Indonesia.
Yes.
Indonesia just initiated an emergency off-cycle interest rate hike, pushing rates to 5.50% specifically to defend their currency, the rupiah. Now, I want to push back or play devil's advocate for a second.
Sure.
If you're casually following the news, an off-cycle hike might just sound like a central bank being responsible and proactive, right? Why is this such a massive, blaring siren?
Well, on the surface, yes, it looks like prudent management. But you have to understand the psychology and the mechanics of central banking. Central banks crave predictability above all else. They map out their scheduled meetings a year in advance.
Right.
They want the market to know exactly when they're going to act. breaking a scheduled meeting calendar is essentially hitting the panic button.
It's like a CEO calling a mandatory all-hands company meeting at 8 p.m. on a Sunday. You don't do that if everything is fine.
No, you do it because something is breaking right now, and it can't wait until Monday morning. If the Indonesian central bank cannot even wait 2 weeks for its regularly scheduled meeting to hike rates, it means they are under immediate severe attack.
Wow.
Yeah, because Chinese manufacturers are squeezed, their demand drops, hitting Indonesia exactly when foreign investors were rapidly dumping Indonesian assets. The rupee was plunging to record lows. This isn't just a temporary blip on a chart. It is the actualization of a pre-existing structural condition.
The economic structure is literally breaking under the dual pressure of higher global borrowing costs and lower Chinese demand. Okay, so Asian emerging markets are clearly feeling the squeeze and the dominoes are falling. But what about Latin America?
Ah, yes.
Because if you read the consensus from Wall Street right now, the broader market is currently treating Latin America like the absolute darling of the global economy.
They really are. The street major institutional players like BlackRock are heavily overweighting Latin American commodity exporters.
Yeah.
And they see the exploding demand for materials like copper to build out AI infrastructure.
Yeah.
And they think Latin America is just a guaranteed gold mine.
Right.
But the memo points out they're completely ignoring severe political tail risks.
And again, we're just neutrally reporting the market risks highlighted in the data here. Gramercy notes that Peru has an unresolved June 7 presidential election. We are talking about literally hundreds of votes separating the candidates with huge immediate risk of mass street mobilization.
And in Colombia, the situation is even more acute. President Petro is explicitly threatening to reject the upcoming June 21 runoff results and take to the streets if De La Espriella wins.
Unbelievable.
The market is pricing these countries purely based on how much copper or oil they can pull out of the ground, completely ignoring the fact that their entire political systems might literally grind to a halt in the exact same calendar week.
It is the definition of a blind spot, which makes the final, purely data-driven recommendation in all of this incredibly ironic. Because amidst all this fragility, the country positioned as the strongest fundamental play right now is Argentina.
I know, to anyone who follows global finance, that sounds entirely counterintuitive.
It really does. Argentina is historically famous for volatility. They practically invented the modern sovereign debt crisis. But the underlying fundamentals right now say they're the exception to the rule.
They are an overweight. Standard & Poor's just upgraded their credit rating to B, joining Fitch.
Which is huge.
It is. This dual agency upgrade is a massive mechanical trigger. It sets them up perfectly for a market-based liability management exercise.
But it's not just a paperwork upgrade, right? Why is Argentina suddenly the safe haven?
Because of the Vaca Muerta energy project. That is their structural anchor. Unlike the fleeting artificial relief of the SPR drawdown in the U.S., Vaca Muerta is actual structural production.
A physical asset.
Yes, it is mathematically projected to deliver a $10 billion energy trade surplus for Argentina by 2026. While other emerging market countries are drowning, Argentina actually has the fundamental underpinning that the rest of the EMBI currently lacks.
It is absolutely fascinating how the narrative completely flips when you force yourself to look past the calendar, past the press conferences and the scheduled meetings. So what does this all mean for you, the listener?
It comes down to the measurement problem.
Right, because credit analysis isn't about predicting the future with a crystal ball. It's about measuring what the price already assumes. And right now, the market is pricing in a perfect world.
Flawless perfection.
Yeah. It assumes the Iran deal holds, Japanese rate hikes don't break EM balance sheets, and Latin American politics remain totally stable.
But borrowed stability always has an expiration date. The meetings ended on time, sure, but the structural debt continues to accrue.
Which leaves you with a final, provocative thought to mull over. If the U.S. Strategic Petroleum Reserve hits 1983 levels by mid-September, right as global borrowing costs fully reprice and Chinese manufacturers can no longer absorb the margin squeeze, what happens to the everyday cost of consumer goods on our own shelves when that dam finally breaks?
The settlement lag eventually catches up to all of us.
Thanks for joining us on this deep dive.